Welcome back, dear learners. Before the ad break, we did some interesting calculations and we recorded in the statement of comprehensive income. Now, I have an application question for you, and it reads, Hussein, the accountant at Lulu Traders, has not been well for some days as he has not been able to prepare the financial statements. You have been asked to assist in the preparation of the statement of comprehensive income, but focusing on three main adjustments. Okay, so here are the three main adjustments. Okay, let us go. We started the first adjustment. It says, a debtor, Deacon, who owed the business 1,355, was declared insolvent. So when a debtor is declared insolvent, that means they are to be written off from our books. Are we together? They are no longer able to pay us. All right. A dividend of 60 cents in the rand was received. So they then paid us 60 cents in the rand, and then we had to write off the remaining amount as irrecoverable. Very important that the difference must be written off as irrecoverable. Now, we are to prepare a statement of comprehensive income, and we must record an amount under our operating expenses. So what we need now is they have given us 60 cents in the rand. Therefore, the amount that we are not able to receive from them is the 40 cents in the rand. So I'm going to come here and say the 40 cents in the rand, 40 over 100. I multiply that by the debt that they were owing us, which is 1,355. That will give me 542. That 542 is what I call bad debts. And we understand that bad debts are an expense. So I'm going to come now to my operating expenses, and I'm going to say bad debts. I open my bracket. Here I have bad debts, 11,100. Bad debts, 11.1, plus these bad debts of 542, plus 542. That is what I've just calculated. If I close that bracket, then I'm going to have 11,642. 11,642. That becomes then my bad debts amount in the statement of comprehensive income under my operating expenses. Let us look at adjustment number 2. Okay, this is what we have just done. This is what we have just done. Let's look at adjustment number 2. It says, received an EFT from a debtor, Miss Elwise, whose account was previously written off. Previously written off, that means this account was written off as a bad debt. Previously written off, it was written off as a bad debt. The moment an account is written off as a bad debt, we remove it from our debtors' accounts. The amount was credited to the debtors' control account. Correct the error. The moment we write off an account as a bad debt, we remove the amount from the debtors' accounts. In other words, it is no longer a part of our debtors' control. The moment that debtor comes back to pay, it no longer affects our debtors' control because that amount was already removed the moment we wrote him off as a bad debt. So the moment that particular individual comes and then gives us the money, it no longer affects our debtors' control. However, it will affect our bank and bad debts recovered. It does not affect our debtors' control. It affects bank because we have received, and that amount of money that we have received was previously written off as a bad debt, so we then call it bad debts recovered. Two accounts are affected, not the debtors' control. In this case, the amount was credited to the debtors' control. Crediting it to the debtors' control is decreasing debtors control because debtors control is an asset account. This is incorrect. All right? So what do? We have to understand that once money is received from a debt which was previously written off, we record it as bad debts recovered. So we're coming here now. Under other operating income, we'll record what is known as bad debts recovered. Bad debts recovered. And our bad debts recovered is the amount that we have received, 890. All right. So in today's class, we are not doing the statement of financial position. I'm only showing you how we record it in the statement of comprehensive income. How we do it in the statement of comprehensive income. We record it as bad debts recovered under my other operating income. All right. Let us now go to adjustment number 3. This is what I just explained to you. Okay. When we look at adjustment number 3, it reads, on 1 July, Ms. Jean, the owner, increased the fixed deposit with 15,000. This was properly recorded, provide for outstanding interest on fixed deposit. We understand that our interest on fixed deposit does not go under other operating income, but it goes towards the end of the statement of comprehensive income. All right, we should have prepared note number 1 for it, but what I want to show you is this calculation over here. Okay, so just below my operating profit, I'm then going to bring my interest income. Okay, now in the list of balances, we are given interest on fixed deposit 2,000. So I'll come here, interest income 2,000. We are told that this 15,000 was properly recorded. That simply means within this 40,000, we have this 15,000. So I'll come and say 40,000 minus 15,000. That will give me 25,000. This is the fixed deposit that we had for the entire year. So I'll take my 25,000 and then I'll say multiply by 10 over 100, multiplied by 12 over 12. And then it will give me 2,500. This is the interest on this 25,000. Then the 15,000 that we have been told it was increased on the 1st of July, we come to it now, then we say 15,000 multiplied by 10 over 100, multiplied by 6 over 12. It was increased on the 1st of July, so for 6 months. That would then give us 750. So for this year, our total interest on fixed deposit is 2.5 plus 750. That will give you 3,250. It's 2.5 plus 750 to give you 3,250. So when I come here, my interest income here must be 3,250. That is what I must be having. But in the list of balances, I've been given 2,000. That means there is an amount that is outstanding, therefore. In the amount outstanding, I'll get the difference between 3,250 and the 2,000. That is 1,250. That becomes the interest that is outstanding. So in my statement of comprehensive income, I'll therefore come and say 2,000 plus the 1,250, and then the interest must be 3,250. Dear learners, let's go for an ad break, and I'll see you shortly.